Something changed today in the silver market, not something dramatic, not something you'll see in mainstream headlines, but something significant enough that if you hold silver, or if you've been watching it, you need to understand what just occurred and what it means for the months ahead. I'm not here to tell you silver is going to the moon tomorrow. I'm not here to promise you overnight returns or sell you a fantasy. I'm here because after years of analyzing monetary policy, commodity cycles, and investor behavior, I recognize patterns. And the pattern that's emerging right now deserves your attention. If you already own silver, you're probably wondering whether to hold, whether to add, or whether you've been foolish for staying patient this long. If you don't own silver, you're likely skeptical, perhaps burned before, or simply waiting for confirmation that you're not just chasing another false rally. Both positions are valid. Both deserve a thoughtful response. And that's exactly what we're going to work through together today. Let me start with what changed. Over the past several trading sessions, we've seen a confluence of technical, fundamental, and sentiment indicators align in silver markets in a way they haven't aligned in years. This isn't about one data point. It's about multiple independent signals beginning to confirm each other. The silver market has broken through a resistance level that has contained prices for an extended period. At the same time, industrial demand indicators are showing strength while above-ground inventories in key exchanges have declined meaningfully. Meanwhile, the backdrop of monetary policy, currency instability, and inflation expectations continues to create conditions historically favorable for precious metals. But here's what matters most. This isn't happening in isolation. The shift in silver is occurring against a broader reconfiguration of how institutional capital is thinking about real assets, inflation protection, and portfolio insurance. That context matters enormously. When you see silver moving, the question is always, is this noise or is this signal? Most moves are noise. Brief reactions to headlines, short-term speculation, technical trades that reverse quickly. But occasionally, you get moves that represent the early stages of a genuine repricing. The difference is in what's driving it. Let me explain why this moment is structurally different from the rallies we've seen and watched fade over the past few years. And I want to be clear, I'm not saying those rallies were wrong, or that people who bought then made mistakes. Markets move in cycles. Some rallies are early, some are premature, some are the beginning of something larger. The difference now is duration and foundation. Previous rallies in silver were often driven by short-term catalysts, a sudden inflation print, a brief dollar weakness, a burst of retail enthusiasm on social media. These moves lacked institutional confirmation. They lacked the slower-moving fundamentals that create sustained trends. What we're seeing now is different because it's built on longer-term structural shifts. Central banks globally are managing unprecedented debt loads while trying to avoid recession. Currency debasement isn't a conspiracy theory. It's explicit policy. Real interest rates, despite rate hikes, remain historically suppressed when properly accounting for actual inflation. This matters because silver, like gold, ultimately responds not to nominal interest rates, but to real rates and to the credibility of fiat currency management. When real rates are deeply negative and when fiscal dominance begins to override monetary policy, hard assets tend to reprice over time. And here's the crucial point. This repricing doesn't happen all at once. It doesn't happen with a clean, straight line on a chart. It happens in stages, with advances and pullbacks, with disbelief and eventual acceptance. We may be entering one of those stages now. Most people fundamentally misunderstand what silver is and how it behaves. They think it's either an industrial metal or a monetary metal, when in reality it's both. And that dual nature creates unique dynamics that confuse most market participants. When the economy is weak, people assume silver will fall because industrial demand will decline. When the economy is strong, people assume silver will fall because safe haven demand will disappear. This framework traps most observers in a perpetual state of skepticism. But the reality is more nuanced. Silver thrives not in simple boom or bust, but in periods of monetary uncertainty combined with economic transition. It thrives when inflation is persistent, but growth is uneven. It thrives when central banks are trapped between supporting markets and defending currency credibility. Look at the current environment. We have an economy that's neither clearly robust nor clearly collapsing. We have inflation that's moderated from peaks, but remains above target and sticky in key categories. We have central banks that want to signal strength, while quietly worried about financial stability and debt sustainability. This is precisely the environment where silver's dual nature becomes an advantage rather than a liability. Industrial users need it regardless of economic headlines. Investors seeking inflation protection and monetary alternatives increasingly recognize its value. And the supply side remains constrained by years of underinvestment in mining. Let's zoom out and talk about the broader forces at play, because you cannot understand silver or any asset in isolation from the monetary and fiscal environment we're operating in. Global debt has reached levels that are historically unprecedented in peacetime. Government debt, corporate debt, household debt, all at levels that would have been considered unsustainable a generation ago. And yet, here we are, not in crisis mode, but in a strange equilibrium, maintained by financial repression and central bank intervention. Interest rates have risen, yes, but consider what hasn't happened. We haven't seen the wave of defaults that traditional models would predict. We haven't seen governments forced to dramatically cut spending. Instead, we've seen debt service costs absorbed through a combination of extending maturities, financial engineering, and accepting higher structural deficits. This is what financial repression looks like in practice. It's not dramatic. It's not a currency collapse. It's the slow, steady erosion of purchasing power. It's the gradual transfer of wealth from savers to debtors through negative real rates and managed inflation. In this environment, what does it mean to preserve wealth? Bonds offer nominal returns, but questionable real returns. Equities have been supported by liquidity, but face valuation questions and earnings pressure. Real estate has appreciated dramatically, but carries its own risks in a changing rate environment. Hard assets, tangible stores of value, become increasingly relevant not as speculative plays, but as portfolio ballast. This is the context in which silver is repricing, not because of hype, because of structural monetary dynamics that are slow-moving but extremely powerful. I don't make appeals to authority, and I'm not going to name-drop specific investors or analysts. But it's worth understanding how institutional thinking has evolved around precious metals and commodity exposure over the past few years. For a long time, precious metals were dismissed as relics, barbarous relics in the famous phrase. Digital assets were the future. Central banks had inflation under control. Diversification into gold and silver was seen as outdated thinking. That narrative has shifted quietly but substantially, not universally but directionally. Sophisticated allocators are recognizing that the monetary regime of the past decade, with unlimited liquidity and suppressed volatility, may not be the monetary regime of the next decade. You see this in central bank gold purchases, which have been running at multi-decade highs. You see this in the revival of commodity funds and real asset strategies. You see this in the increased attention to inflation-protected instruments and alternative stores of value. Silver specifically has been gaining attention because it's under-owned relative to gold, because its industrial applications are expanding, especially in green energy transition, and because the supply response to higher prices has been slower than in previous cycles. Smart institutional money doesn't chase. It accumulates quietly over time when valuations are attractive and fundamentals are improving. They don't wait for confirmation. They build positions when others are still skeptical. That's how you get favorable risk reward. Let's talk about the physical fundamentals, because ultimately, price is a function of supply and demand, even if that relationship can be distorted by paper markets and sentiment in the short term. Silver mine supply has been essentially flat for years. New discoveries are rare, development timelines are long, existing mines are depleting, and unlike gold, where recycling provides meaningful supply, silver recycling is limited because so much silver is consumed in industrial applications in quantities too small to recover economically. On the demand side, we have steady industrial consumption plus growing demand from solar panels and other green technologies. We have investment demand that surges during periods of monetary concern. And we have emerging markets where middle-class wealth is beginning to look at precious metals as stores of value. Now, the paper market can suppress prices below physical fundamentals for extended periods. Futures markets, option strategies, ETF flows, all can create price action that doesn't reflect underlying physical tightness. But eventually, physical reality asserts itself. When inventories in major exchanges decline, when premiums for physical metal over paper prices widen, when delivery pressures emerge, these are signs that the paper market may be losing its ability to suppress physical fundamentals. And we're seeing some of these signs now. I'm not predicting a shortage or a squeeze. I'm simply noting that supply-demand balances in physical commodity markets matter, and they appear to be tightening in ways that haven't been true for several years. If you've been holding silver, perhaps for months or years, you've probably experienced frustration. You watched it rally and fall back. You heard predictions that didn't materialize. You wondered if you were wrong to maintain exposure. Here's what I want you to understand. If you bought silver as a long-term hedge, as portfolio insurance, as protection against monetary instability, then short-term price action was never the point. The point was having exposure to an asset that performs when other parts of your portfolio struggle. What today's developments suggest is that the patience may be beginning to pay off, not because silver is guaranteed to go straight up from here, but because the fundamental case for owning it is strengthening, the technical setup is improving, and the macro backdrop is becoming more supportive. Your job now is to avoid the emotional traps that catch most people. Don't get euphoric if prices rise quickly. Don't assume this time is different and leverage up your position. Don't abandon the discipline that led you to own silver in the first place. Instead, ask yourself, does silver still serve its purpose in my portfolio? Is my position size still appropriate, given my overall wealth and risk tolerance? Am I prepared to hold through volatility if this develops into a genuine trend? If you bought silver as a hedge, it's doing its job by existing in your portfolio. If prices appreciate significantly, you might consider rebalancing some gains into other assets. But the core position should remain as long as the monetary environment that justified it remains in place. If you don't currently own silver, you're probably experiencing a different set of emotions. Perhaps regret at having missed the entry point. Perhaps skepticism that this is just another false rally. Perhaps curiosity but uncertainty about whether now is the right time. Let me be direct. Chasing assets after they've moved is generally unwise. Buying something because you're afraid of missing out is emotional decision-making. And emotional decision-making in markets leads to buying high and selling low. However, dismissing silver entirely because it's moved is equally problematic. Trends don't end because you didn't catch the bottom. Strong moves often continue further than skeptics expect. And sometimes the best entry points come during early pullbacks in new trends, not at absolute bottoms. If you're considering silver exposure, do it thoughtfully. Educate yourself on what you're buying and why. Understand that silver is volatile, that it can correct sharply, that it doesn't move in straight lines. Determine a position size that allows you to be comfortable through volatility. Consider starting with a smaller position and being prepared to add on weakness, rather than trying to time a perfect entry. Consider whether you want physical metal, ETFs, mining stocks, or some combination. Each has different characteristics, different tax treatment, different liquidity, and most importantly, be honest about your time frame and your objectives. If you're buying silver hoping to flip it for quick profit, you're likely to be disappointed and shaken out. If you're buying it as a long-term portfolio hedge with the patience to hold through cycles, your odds of success are much higher. Understanding market psychology during regime changes is critical to navigating what may be ahead, and I want to prepare you for what genuine trend changes look like, because they rarely match our expectations. When a market transitions from a consolidation or downtrend to a new uptrend, it doesn't do so with clear signals and universal agreement. It does so with doubt, with pullbacks that look like failures, with most participants remaining skeptical until the move is well advanced. The early stages of trend changes are characterized by disbelief. Prices move higher, but skeptics find reasons to dismiss it. It's just a short squeeze. It's retail speculation. It won't last. This disbelief is actually what allows trends to develop, because universal belief would mean everyone is already positioned and there's no new buying power. As trends mature, you see shifts in narrative. The very people who were dismissive begin to acknowledge the move but claim it's overdone. Then they acknowledge it's real but say they'll wait for a pullback. Then they capitulate and buy near peaks. I'm not predicting silver follows this pattern. I'm explaining how market psychology works so you can recognize it if it does develop. The key is to make your decisions based on fundamentals and your own analysis, not based on where you perceive the crowd to be in this emotional cycle. Let's get specific about what drives precious metals over meaningful timeframes, because understanding this will help you make better decisions, regardless of short-term noise. Precious metals are not productive assets. They don't generate cash flow. Their value is entirely as stores of value in portfolio insurance. Therefore, their price is primarily driven by the opportunity cost of holding them versus interest-bearing alternatives. When real interest rates, meaning nominal rates minus inflation, are high, the opportunity cost of holding metals is high. You're giving up meaningful real return to hold an inert asset. When real rates are low or negative, the opportunity cost is low or even negative, meaning you're getting paid in real terms to hold the metal. Right now, despite nominal rate increases, real rates remain suppressed when you account for actual inflation in goods and services people consume. Official inflation metrics have moderated, but they remain elevated by historical standards, and many experienced costs suggest headline figures understate reality. Furthermore, the path forward for real rates is constrained. Central banks want to maintain real rates at neutral or slightly positive to control inflation. But debt dynamics may prevent significant real rate increases without triggering financial instability or recession. This is the environment where precious metals tend to perform well over multi-year periods, not because of speculation, because the fundamentals of the opportunity-cost equation favor holding real assets over holding currency or low-yielding bonds. Let's talk about something most finance content ignores: proper risk management and position sizing. Because understanding an opportunity means nothing if you size it inappropriately and get shaken out by normal volatility. Silver can easily move 10, 15, 20% in a matter of weeks. This volatility is both opportunity and danger. It's opportunity because if you're right about direction, gains can be meaningful. It's danger because if you're oversized, the volatility will force you to make emotional decisions. The appropriate position size for silver depends entirely on your personal financial situation, risk tolerance, and portfolio composition. For some investors, a small 3 to 5% allocation makes sense as portfolio insurance. For others, comfortable with volatility, a larger position might be justified. There is no universal right answer. What matters is that your position size allows you to hold through volatility without panic. If a 20% decline in silver would cause you to sell at a loss or lose sleep at night, your position is too large. If a 20% decline would be something you could comfortably ignore or even view as a buying opportunity, your sizing is probably appropriate. Also consider whether you're using leverage, either explicitly through futures or margin, or implicitly through mining stocks, which provide leverage to metal prices. Leverage magnifies both gains and losses. It can turn a normal correction into a devastating loss if you're oversized. The goal isn't to maximize theoretical returns. The goal is to maintain a position that serves its portfolio purpose while allowing you to stay rational and disciplined through inevitable volatility. Understand your own psychology and size accordingly. Let me be very clear about behaviors that will likely hurt you during this period, regardless of what happens with silver prices. Do not react emotionally. Markets reward patience and discipline. They punish emotional decision-making. If you find yourself feeling euphoric or panicked, step back from making decisions until you've regained emotional equilibrium. Do not chase prices frantically. If silver has moved and you don't have a position, assess calmly whether the opportunity still exists at current levels. Buying because you feel you're missing out is a recipe for buying high and selling low. Do not leverage up aggressively. Using margin, options, or futures to magnify your exposure might seem attractive when you believe prices are going higher, but leverage is what destroys accounts during normal volatility. The move you're right about can still wipe you out if you're over-leveraged and experience a temporary pullback. Do not blindly follow social media hype. Online financial communities can provide information, but they can also create echo chambers that reinforce bias and encourage excessive risk-taking. Make your own decisions based on your own analysis and circumstances. Do not assume this time is different. Markets have patterns and cycles. Bubbles form and burst. Trends develop and reverse. Maintaining humility about what you know and don't know is essential to long-term success. Do not ignore other aspects of your financial life. Silver, or any single asset, should be part of a broader financial plan that includes emergency savings, diversification, insurance, and planning for goals that matter to you. Never let a single investment thesis override fundamental financial prudence. I want to step back and place this moment in silver within a larger context. Because the real opportunity and the real risk comes from understanding which part of a long-term cycle we might be entering. Monetary history shows clear patterns. Periods of currency expansion and debt accumulation are followed by periods of inflation, financial repression, or currency crisis. The specific form varies, but the pattern is consistent. No currency has maintained stable purchasing power indefinitely, while being managed by political institutions, with incentives to debase. We've been in an extended period of currency expansion and debt accumulation, not just in one country, but globally. The response to the financial crisis, to the pandemic, to each subsequent challenge, has been more debt, more stimulus, more monetary intervention. This can continue longer than skeptics expect. Modern monetary theory advocates argue it can continue indefinitely. History suggests otherwise. The question is not whether there will be consequences, but when and what form they will take. Precious metals, and silver specifically, are a way to position for this scenario where currency management becomes difficult, where inflation proves more persistent than central banks desire, where debt dynamics constrain policy options. This doesn't mean currencies collapse or economies fail. It means that real assets, tangible stores of value, may outperform financial assets that depend on the credibility of monetary and fiscal management. We don't need a crisis scenario for silver to perform well. We only need a continuation of the slow erosion of purchasing power, the managed inflation, the financial repression that characterized the past decade and appears likely to continue. One of the hardest skills in investing is distinguishing meaningful information from meaningless noise. And this skill is particularly important in silver, where the signal-to-noise ratio is often very low. Every day there are headlines about silver, predictions from analysts, technical analysis suggesting breakouts, fundamental analysis suggesting value, social media posts claiming manipulation or imminent explosions in price. How do you filter this? Start by recognizing that most short-term price action is noise. Daily, weekly, even monthly moves can be dominated by technical factors, positioning, sentiment shifts that have nothing to do with underlying value. Focus on slower-moving fundamentals, supply and demand balances, monetary policy trajectories, real interest rate trends. These factors don't change daily, but they determine direction over quarters and years. Verify claims independently. If someone states a fact about inventories or production or demand, check the source. If someone makes a prediction, ask what their track record is. Be particularly skeptical of claims that sound too good to be true or that rely on conspiracy theories. Recognize that uncertainty is normal. You will never have complete information. You will always be making decisions with incomplete data. The goal is not certainty, but probability. Position sizing should reflect your uncertainty. Let's address the hardest part of investing in volatile assets: maintaining conviction through drawdowns and resisting euphoria through rallies. If silver does develop into a sustained trend, it will not move in a straight line. There will be pullbacks. There will be days, possibly weeks, where it looks like the move is over. This is where most people fail. They buy on strength, convinced this is the beginning. Prices pull back. Fear creeps in. They question their thesis. They sell at a loss. Then prices recover, and they feel foolish, either staying out or buying back at higher prices. The way to avoid this trap is to do your analysis before you invest, not after. Determine what would invalidate your thesis: a certain price level, a change in fundamentals, a shift in monetary policy. Know your exit criteria in advance. Then when volatility occurs, you can assess calmly whether your exit criteria have been met. If not, the volatility is noise. If your thesis remains intact, pullbacks might even be opportunities to add to positions. On the other side, if prices rise substantially, euphoria becomes the danger. The feeling that you should be more aggressive, that you're not taking full advantage. This is when many people increase positions at exactly the wrong time. Successful investing requires emotional discipline in both directions. The ability to buy when uncomfortable and to take profits or hold when exuberant. This discipline comes from having a clear plan and following it regardless of how you feel. If you've decided silver deserves a place in your portfolio, either as a new position or in addition to existing holdings, let's discuss practical execution. First, decide what form of silver exposure you want. Physical metal provides the most direct exposure and eliminates counterparty risk, but comes with storage and insurance considerations. ETFs provide liquid exposure with minimal friction, but involve counterparty risk and don't give you physical possession. Mining stocks provide leverage to metal prices and potential dividend income, but come with company-specific risks, management risk, and political risk related to where mines operate. Futures and options provide maximum leverage, but are appropriate only for sophisticated investors, comfortable with potential total loss. For most investors, a combination makes sense. Some physical metal for the psychological security and lack of counterparty risk, some ETF exposure for liquidity and ease of trading, possibly some mining exposure for those comfortable with equity risk. Regarding timing, if you're initiating a position, consider dollar cost averaging over several months rather than investing all at once. This reduces the risk of entering at a temporary top and allows you to acquire metal at an average price through normal volatility. If you're adding to an existing position, be cautious about adding too much too quickly after a strong move. Let the market give you opportunities during pullbacks rather than chasing strength. Ultimately, successful investing in any asset requires maintaining perspective on what you're trying to achieve and over what time frame. If you view silver as a short-term trade, as something to flip for quick profit, you're likely to be disappointed more often than not. Short-term price movements are largely unpredictable. Technical analysis can provide guidance on probabilities, but nothing is certain over days or weeks. If you view silver as a long-term portfolio holding, as insurance against monetary instability, as a hedge against inflation and currency depreciation, then short-term volatility becomes irrelevant. What matters is whether the long-term fundamental case remains intact. The fundamental case for precious metals exposure, in my assessment, is stronger than it's been in years, not because of any single event or data point, but because of the cumulative weight of monetary policy decisions, fiscal trajectories, and debt dynamics that appear increasingly difficult to manage without consequences. This doesn't mean silver will go up in a straight line. It doesn't mean there won't be periods where it underperforms or declines. It means that the probability of silver significantly outperforming cash and inflation over the next several years appears higher than it has in recent memory. A disciplined approach to any investment requires considering what happens in different scenarios and ensuring you're prepared for each. Scenario 1, silver consolidates or declines from here. Perhaps I'm wrong about the significance of recent developments. Perhaps the technical breakout fails. Perhaps macro conditions shift in ways I haven't anticipated. What do you do? If your position is properly sized and you bought silver for long-term reasons, you hold. You might even add opportunistically if prices decline and fundamentals remain intact. You definitely don't panic, sell at a loss. Scenario 2, silver rallies significantly in the near term. Perhaps it moves 30, 40, 50% over the next several months. What do? You resist euphoria. You don't dramatically increase your position after a big move. You might consider taking some profits to rebalance your portfolio, especially if silver has become an outsized portion of your wealth. But you maintain core exposure as long as fundamentals support it. Scenario 3, silver moves sideways for an extended period. Perhaps we see range-bound trading for months with no clear direction. What do? You remain patient. You recognize that consolidation periods often precede larger moves. You avoid the temptation to abandon your thesis out of boredom or frustration. You maintain discipline. The key in all scenarios is having predetermined criteria for your decisions rather than reacting emotionally to price action. Before we conclude, I want to address something that goes beyond silver specifically, a question about what wealth really means in an era of monetary uncertainty. We've been conditioned to think of wealth in nominal currency terms. How many dollars, euros, yen we have. We measure investment returns and percentage gains of currency. We evaluate success by the growth of balances in accounts denominated in fiat money. But wealth, at its core, is about purchasing power. It's about your ability to acquire goods, services, and experiences. It's about maintaining the economic freedom to make choices about your life. In an environment where currency purchasing power is being deliberately eroded through inflation, where financial repression keeps real rates negative, where debt is being inflated away at the expense of savers, nominal gains can be illusory. You might see your account balance grow by 5% while your actual purchasing power declines by 3%. Are you wealthier? By one measure, yes. By the more important measure, no. This is why hard assets, real assets, tangible stores of value become relevant. Not because they offer spectacular returns, because they preserve purchasing power when paper assets may not. Silver is one option among many for this purpose. Real estate, productive businesses, commodities, land, all can serve similar functions. The specific allocation depends on individual circumstances and preferences, but the broader principle is worth understanding. In an era of monetary experimentation and debt management, conventional measures of wealth and investment success may not tell the complete story. As we near the end, I want to acknowledge what I don't know and what could make my analysis wrong. I don't know the future price of silver. No one does. I'm offering an assessment of probabilities based on current conditions and historical patterns, not a prediction. I could be wrong about the significance of recent technical developments. Markets give false signals all the time. What looks like a breakout can reverse. What appears to be a major shift can prove to be noise. I could be wrong about monetary policy trajectories. Central banks might successfully navigate inflation back to target without recession. Fiscal policy might become more disciplined. Debt dynamics might prove more manageable than I expect. I could be wrong about how investors will behave. Perhaps the preference for paper assets continues indefinitely. Perhaps digital currencies supplant precious metals as alternatives to fiat. Perhaps new technologies I haven't considered change the fundamental equation. Maintaining intellectual honesty about uncertainty is crucial. It prevents overconfidence. It encourages appropriate position sizing. It keeps you open to new information that might contradict your thesis. The goal isn't to be certain. The goal is to make probabilistic assessments, position accordingly, and remain flexible as conditions evolve. Here's what I want you to take from our time together today. Something has shifted in silver markets. Whether this shift proves to be the beginning of a sustained trend or a false start will only be clear in hindsight. But the confluence of technical, fundamental, and macro factors suggests this moment deserves attention. If you hold silver, maintain your discipline. Don't let short-term price action override your long-term strategy. Don't become euphoric in rallies or despondent in pullbacks. Let your position serve its portfolio purpose. If you don't hold silver, but are considering exposure, do so thoughtfully. Educate yourself. Size appropriately. Focus on long-term fundamentals rather than short-term price speculation. And recognize that timing perfection is impossible, but long-term positioning based on sound analysis can work out well over time. Regardless of your specific decisions about silver, the broader lessons apply to all investing. Understand the macro environment you're operating in. Distinguish signal from noise. Manage risk through position sizing. Maintain emotional discipline. Think in probabilities, not certainties. The monetary environment we're in is historically unusual. Record debt levels, unprecedented central bank intervention, persistent inflation, negative real rates. This creates both opportunities and risks across all asset classes. Successful navigation requires staying informed, thinking independently, and maintaining the humility to recognize what you don't know. It requires patience to hold through volatility and discipline to avoid emotional reactions. I don't know if today will prove to be a major turning point in silver markets, or simply another moment that seemed significant at the time, but faded from memory. What I do know is that the underlying conditions that make precious metals relevant are very much in place. The question isn't whether you should react immediately or dramatically. The question is whether you have a coherent framework for thinking about monetary risk, portfolio insurance, and wealth preservation. For some of you, silver will be part of that framework. For others, different assets will serve similar purposes. What matters is that you're thinking seriously about these issues rather than assuming the monetary status quo will continue indefinitely. Stay informed, stay disciplined, stay patient. The markets will continue to create opportunities for those who maintain perspective and avoid the emotional extremes that trap most participants. Thank you for your time and attention. I hope this analysis has been valuable regardless of what you decide to do with it. The goal has never been to convince you of a particular position. but to help you think more clearly about the forces at play and how they might affect your financial future. Until next time, take care of yourselves and your wealth. And remember, in uncertain times, knowledge and discipline are the best investments you can make.